Welcome to the CoreData podcast. And joining me today is Brett Jollie, who ran Aberdeen Asset Management here in Sydney for 14 years. Today we're looking to discuss the market, opportunities and challenges facing asset managers. Brett, thanks for joining us.
It's great to be here.
Brett, let's kick off with where are we today then? How are things out there in the market?
Well, it's nice to be here today, so thank you for having me on.
You're welcome.
We are at the tail end of a 30-year investment super cycle. So this has really driven investment markets. It's driven the funds management industry and all the industries that sit around the funds management industry. Over the last 30 years, we've seen interest rates come down from double digit. We've seen the increase in globalisation, increase in global trade, decrease in geopolitical issues and concerns around the world. And these have driven asset growth, investment in investment markets and the funds management industry, particularly in developed markets, developed countries where you've got ageing populations, you've got pension systems which are scaling, growing. We only have to look at Australia with its superannuation system that really has helped grow the asset management industry down here.
So end of a super cycle, you say, Brett. That's very interesting because we are in buoyant markets at the moment. We've seen a lot of volatility. We've seen various macroeconomic political issues over the last 5 years. If we just hark back we don't go back to the financial crisis, just from COVID and beyond. Markets have managed to bounce back. They are at all-time highs, which comes with it a sprinkle of risk, I suppose, if things are as good as they are. I think what I'd like to explore are what are some of the challenges maybe that the incumbent providers are facing or have been facing, given the competition and the onset of passive, the continued rise of those guys, the demand that we're seeing in our research from investors across the retail, wholesale, institutional spectrum in terms of broader diversification. We've seen a kind of a collapse of correlations in some asset areas. So if you were running an asset manager tomorrow or even today, later this afternoon, what might you be trying to what looking glass would you be looking through to sort of drive things forward?
Yeah. Okay, well, you touched on a lot of the issues. There are certainly the tailwinds that I referred to earlier, in many instances have become headwinds. So we have seen, that we do have higher geopolitical concerns today. We have had a rising inflationary environment, and a rising interest rate environment. We've got imposition of tariff policies out of the US. What's that going to do longer term? So there's a range of challenges that are impacting the industry today. And around that, as you say, you throw in a range of other headwinds that, particularly for the traditional asset managers, I'm talking about the ones that have been successful over the last 20, 30 years, have built up big back books of business, done very well, particularly in traditional asset classes, I should say. Over the last 10 plus years, it's no secret that most active fund managers have underperformed markets for various reasons, which we can discuss. But that creates challenges for them.
You mentioned the traditional asset classes. If you were given the keys to your new shiny asset management business tomorrow, what would be the first thing that you would look to? Would you look at sort of the distribution evolution, how that market's changing to start with before you maybe look at your suite of products? Or would you perhaps look at the operational efficiencies? There's a lot of talk in the industry around how technology is really going to drive the asset manager of the future and how active managers can maybe outperform through some of those areas. Or perhaps, and these are just ideas, the third one might be on the personnel side. I mean, how hard is it these days? We've come out of a work from home environment, retaining quality staff in a competitive field. Which areas might you try to sort of touch on first if you were to start?
It doesn't depend in part on your business model, right? Are you a small boutique specialist and you focus on one core strategy, you want to do that really well, or are you more of a broad, bigger, diversified fund manager, which is the sort of house I came out of at Aberdeen? If I was focusing on the latter there for now, Clearly, product matters, right?
Yeah.
What do investors want, right? It's tapping into that. You need innovative products, strategies. You need to ensure that you have a healthy product pipeline. You're bringing new ideas through, new strategies to market. Clearly, that's important, and that covers all asset classes. There's a trend to private markets. Yeah. For various reasons, partly because of the underperformance of the traditional asset classes, for active managers that is, and you've got a trend towards passive investing. So many investors now access more of the traditional equity markets, which you could argue are more efficient, certainly, through passive ETFs, the rise of the ETF. Yeah. And around this, of course, in the institutional channel as well, you've got more in housing. You've got what I'd call certainly distortionary policy coming through, and particularly in the Your Future, Your Super performance benchmarking, which is driving a more conservative investment methodology for superannuation funds.
So what research has shown, yes, a significant demand for diversification, and you've touched on some of those areas in private markets and hedge funds and credit and all those sorts of realms. But where do you think, then we look at the distribution side of the table, we have obviously advisory, we have potentially more of a tech-driven, self-guided solution, the robo side of things. Then we creep into wholesale and institutional. Do you think education is a challenge? People, if investors are looking for more diversification and outperformance or arbitrage, as it were, away from what they can get cheaper through the passives, do you think the industry can do any? If you're a mid-size asset manager, how do you then communicate, or how do you educate the market around your product suite if you're moving into more esoteric areas, for example?
Yeah. So as a broad statement, I'd say education is key. Yeah. Financial advice in Australia is critical. I think it's well recognised that the financial advice framework in Australia needs enhancing or improving because it's broken right now. There's not enough financial advisors to service the population. Most people, I don't think only 1 in 5 people seek financial advice. It's expensive. The way that the regulations are structured, it makes it out of reach for most mum and dad investors. Yeah. That is an issue. From a funds management perspective or a fund provider, education is important. I mean, the surveys that come up time and time again in terms of what do investors, and I'm putting financial advisors and all the intermediaries in here, what importance, or what do you see as the most important piece of output from a fund manager? It's thought leadership consistently. Yeah. So we need to be able to educate and provide guidance and support our investors in terms of knowledge around products, asset classes, strategies, what we're doing, and so on.
Yeah. I mean, it's funny you should mention that, because we've done recently a piece of research. If we look more at the, let's say, more sophisticated end of the market, the institutional market, CoreData did a piece of research. Data came back, around 2/3 of them took thought leadership from some of the best providers in specific asset class areas where they have expertise, and they married the thought leadership that came out of those firms very closely with intention to invest, not necessarily with those managers, even though there was an element of that, but it just raised the comfort level, even at the sophisticated investor level, that was the right thing to do, because there's so many nuances. And then the impact that then had on sort of brand attribution in terms of favorability, that also rose. So that's at the sophisticated end. But then if we go with that, it's not a scale of sophistication, but if we look at the retail end, advisors have a job, as you say, to educate clients. But how would, let's say, a mid-sized manager that is launching XYZ product, are there any efficiencies they can gain to provide the thought leadership in a more economical way? Because they won't have the deep pockets to spend on the marketing components, managers having to be more nimble. Is there any advice you can think of for a manager for how do they educate without having to have that internal infrastructure? Could they outsource, for example, some of those things?
Yeah, look, technology does help. Social media is clearly a way of tapping into a large audience, and most fund managers obviously use social media for that reason. It's a very cost-effective way of communicating to your investors. look, you need to have thought leadership in the first place. Yeah. So you need people on board willing to commit to putting down on paper or sitting in front of a podcast such as this to ensure that they can communicate those. And I think sometimes that does go amiss. There's too much focus on, all we're doing is investing. If you're not communicating with your clients, though, you're not providing them with a service. And as we've just discussed, thought leadership is top of mind when it comes to requirements.
So if we dig into some of maybe the specific challenges, so maybe let's talk distribution first. So the power of the gatekeepers, so let's say in the intermediary channel, asset managers, ratings, the ratings houses still play a critical role in Australia in terms of visibility and accessibility to product. Do you think that's going to continue, or do you think there's a way for managers to work with, because we've seen also obviously consolidation in the distribution channel with advisor networks merging or being bought up by private equity or so on. Do you think there's anything that can be done, not to go past the research houses, but we're seeing evidence that some managers at the boutique end are abandoning the advisory channel, as critical as that is for distribution, and looking more at the wholesale market, so getting inside model portfolios, so their brand becomes a bit less important, and it's more of the power of whatever that entity is. If it's a Morningstar or a Zenith, for example, you've got your keys again to your new manager. Is it binary? Do you try to play both those sides of the equation, or?
No, look, the research houses are key. The consultants. There has been a proliferation of consultants, small consultants, in the last 5-10 years. Today, I couldn't tell you, there's probably 40 to 50 consultants out there building model portfolios for managed accounts for financial advice groups. That's been a growth area. Yeah. Managed accounts as financial advisors seek more efficient ways of implementing their investment portfolios, their investment strategies for their clients. So they're engaging these small consultant firms. They're essentially outsourced CIO models. Okay. So that's a big and growing piece of the market. That's important, right? Managed accounts. Then you've got your traditional gate, the Zeniths, the Lonseks and so forth. Yeah. Traditional gatekeepers through to the platforms, the dealer group APLs and the models. And ideally you want to get into those models. Yeah. Obviously you can, at the same time, you should be looking at high net worth, the bigger groups or the high net worth investors who don't necessarily require third-party research, but they still like it. It's a validation on your own investment process.
Does that then come back to social media and the power of tech to promote, and even thought leadership, for example, to win over those investors without and cutting out the middlemen as such with the advisors or the research houses?
Well, it's almost a case-by-case basis for those groups. Do they have their own internal research, right? You've got to get, you will need to go through a research process of some sort of due diligence on your own capabilities.
Yeah. And then maybe just quickly, just to wrap up this little section on institutional. So how does a manager compete in the institutional market? Let's say super funds, for example. They've obviously got gargantuan in size in Australia. A lot of them have taken investment in-house. I mean, how do you negotiate? How do you engage with those?
Yeah, that's a challenging one. The superannuation industry is big, as we know, and it has provided them with the scale to, in many cases, bring their investment management capabilities in-house. Certainly where they feel they can replicate it, strategies. So we are increasingly seeing that. From a distribution perspective, putting on my funds management cap, that is a channel that we're seeing less growth in across the industry. So there's a pullback in terms of distribution into the institutional channel, clearly just because they're running the strategies themselves. Now, it's not in all cases, I should note, because there'll be alternative strategies, offshore strategies.
That's what
that
I
can't
was going
be
to
replicated.
say. How sophisticated can a traditional super fund be within its investment team on the whole gamut of the investment spectrum? And I'm guessing there are gaps where they outsource or they use externals.
Absolutely. So you find those gaps. Yeah. Harder for small boutique Australian domestic fund managers. You might find a gap. The the bigger global offshore managers probably find it easier to access those strategies or have those strategies that the local superannuation funds can't replicate today. But certainly, we are seeing. You just look at distribution managers and how big are these teams inside fund management organisations today?
Yeah, they're shrinking.
They're shrinking, absolutely. And distribution strategies are shifting away from super, not entirely, but shifting their focus more towards wholesale markets.
Is there anything in that regard that managers can do to sort of overlay their processes? There's so many things in terms of, obviously we've got market shocks. You touched on a few at the beginning, the current elements, but then there's the longer term things. We're looking at longevity. We're looking at tax receipts for governments shrinking. There's a whole bunch of broader issues that now kind of sit within, obviously the climate aspect, that sit within ESG in a forward-looking view of what that is, which is around investment resilience. How do expert managers, do you have a view on how they think about that and how that can be a differentiation in terms of product set that maybe you just talked about the super funds trying to do some of these things themselves? They might not have the capacity to cover all that kind of consideration, do you think?
Look, I think in 10, 15 years' time, we won't be talking about ESG in terms of incorporating into an investment strategy. It'll just be standard. And I'd say managers are moving in that direction today. Some are far more advanced than others, but incorporating environmental, social governance factors into your investment process is just ensuring that you're covering the risks. What are the long-term risks for your investment portfolio and how do you manage them?
Okay.
Understanding the underlying companies you're investing in and how those factors influence your investment decisions. I think that's just fundamental to investing. That's the direction we're heading. The ESG risks are financial risks and you need to be monitoring them. Now, looking purely at the ESG opportunities, like clearly there's massive opportunities for transitioning, the energy transition, for example. So you can focus on specific strategies that hone in on those opportunities as well. So it depends on your strategy and what you're trying to do, and you could have subsets of your investment philosophy and process and target specific sectors, like the energy transition as an example, that may be attractive to certain cohorts of your investment base.
Yeah. Okay. Excellent. We can't do the conversation on challenges without talking about fees and costs, but maybe we can think of it slightly different. So obviously they're two ends of the same pie, income, outgoings. Where's the sweet spot? Because managers, if they're looking into areas where there's more capacity for arbitrage, so potentially alpha outperformance, and as such perhaps ideally fees that are more commensurate with those services. What's the balance between running lean and running mean, if that makes any sense? Do you think with whether it's outsourced providers that are out there to provide some of the elements that were traditionally run inside an asset manager, like a light sailing boat, for example, can asset managers now run with just a core component of operations and then save money in that way? Or is it just you have to charge what you have to charge and the cost has to be the cost? I mean, what's your view on those two competing?
Okay, so first of all, costs are coming, in terms of revenue, margins are coming down. Yeah. It's a highly competitive market. Certainly at the institutional level, superannuation funds in the main have been very successful in driving fees down over many years to very low levels. Working for a global fund manager, we operated a global rate card for our investment strategies. We could not sell our strategies, take your pick, global equities, for example. We could not sell global equities into Australia at the global rate card because the market was so competitive. We were operating below it. So I had to get special dispensation to get a discount on those fees to sell. And we turned away a lot of mandates for that reason, because we could get bigger mandates at high margin in the States, for example, which surprised, people would think in the United States there's highly efficient market. Well, when it comes to fees, Australia leads.
Okay. So on the cost side then, does that mean that managers have to be just ruthless on the cost side?
So need to be efficient, absolutely. And I should note too that we're seeing a decrease in fees across other segments as well. So wholesale fees are coming down as well. So yes, absolutely. Managers need to be efficient, particularly in light of the fact, I go back to those big traditional managers that have been very successful over the years, probably underperformed over the last 10 years. Yeah. They're starting to see outflows, and well, they have been seeing outflows. And what's going out the door is higher margin business than what's coming in. Okay. So for every dollar that goes out, you've got to win $2 to come in. Okay.
So maybe just also scalability then. So mergers and acquisitions, managers joining up and trying to build scale. It's a very generic way to look at it, but is that an outcome if you've whether you've shrunk?
Yeah, absolutely. Let me just finish that last piece. Fund managers need to run efficient businesses. Like any industry, you need to run efficiently. I'm a firm believer in, if you're an investment manager, focus on your core strengths, outsource your non-core business. There are specialists that can do, operations more efficiently than you can internally. I mean, there's a rump that you need to do internally, but you can outsource your unit registry, fund administration, all that sort of back office stuff. You don't need to be doing it because it comes at a cost, high head count, and it makes it harder to scale as well. So M&A, absolutely. I mean, I firmly believe, get back to my earlier comment at the beginning, we are at a pivotal point in the industry. I think there's massive opportunities out there. Okay. But I also think there's a lot of fund managers out there that are struggling right now. I know that because I go and speak to them. Okay. I saw that firsthand at Aberdeen, your traditional managers. If your outflows are larger than your inflows and you're not performing, you're in trouble.
There's only so long you can keep your head above water with that.
Exactly. So we are seeing, there are fund managers looking to exit, either through M&A, mergers, or whatever. And there's businesses out there looking to acquire. I mean, I'm working with one right now. And so it creates opportunities for change, new entrants.
Well, let's just dig into that opportunities side of things then, just to sort of get towards wrapping up on the conversation. Where we've done a lot of research around, in Australia specifically, the wealth transfer, this demographic cliff. It's not it sounds like a sudden event, but it's a tail event that's going to run and run and run. Yeah. Obviously, as wealth is transferred, we have different demographics, we have different age groups of people who now have capital, for example. We have different mindsets, attitudes towards different types of investing, engaging with third parties, working with advisors, utilising technology. So where do you think some of the key battlegrounds are likely to be if we think about funds management to 2030, the funds management over that next 5-year period? What race should these guys be looking to run, and how can they? You touched on some of the opportunities. But where do you think is best?
It's a good question. Look, I think in terms of there are quite a number of very successful boutique managers out there that are largely owned by one or two founders. I think they're getting to the point where they're probably looking at how do we get out? What's our succession planning? So again, opportunities arise for others that looking to build on their existing capabilities. You go down the wealth chain, right? Businesses within the value chain, financial advice groups. There's a lot of small financial advice groups out there, quite often started up by a single founder looking to exit the business as they move towards retirement.
The cost of, just jumping in onto that, I mean, our research shows that there are a significant number of advisors running their own AFSLs, which has merits in terms of independence, but systemic risks in other areas, not through malpractice, but just on the basis that it's a difficult business to run single-handedly. Where do you think distribution? So you talked about before as well, a shrinking advisor pool, but if we think about the pot, so as opposed to the opportunities from a industry perspective, mergers, more efficiencies, in terms of chasing that pot of gold, as it were, what should managers be looking at if we're looking at whether it's high net worth, family offices, retail money, digital fund flows and things like that? Where do you think the prize is biggest or sweetest, as it were?
Look, one area that comes to mind is pension, the decumulation phase of the superannuation or the retirement system. So we've got roughly, I think, 75% of the $4 trillion in superannuation still sits in an accumulation phase. But something like $80 billion is transitioning to decumulation each year. Over the next 20 years, we're going to see roughly 50% of that pool move into decumulation. And while we've been very good as an industry building up an accumulation framework, set and forget largely, get your asset allocation right and set it and take a long-term view. Retirement's different. The decumulation phase is very different. And I don't think we've nailed that one yet.
And if you marry that against the demographic changes, people living longer, our research, we look at older Australians who, they live a more active life for longer, and they don't necessarily retire and sit around. So I think the product set of the industry needs to match that, and it's not necessarily straight into lock-in full conservative mode. Assets have to continue in that decumulation phase to grow. Obviously, exposure to volatility and those market risks in the process. But I think if you're taking a view that demographics, the average age is now 85 or something in Australia, but then also the decumulation phase happening sooner for some people, where they're making lifestyle changes when they're in their late 50s, for example. So they're not running straight to the end of the retirement. So that's almost in line with the period of accumulation. So how do you make a pot stretch that? And that's, I think, where the diversification comes in, because people want growth, but they want a lower risk. And I think there's certainly a huge opportunity for product sets and areas that may not have even come to pass yet. I mean, obviously we're still seeing in the area of digital currency, for example. Not that I'm personally an advocate of crypto or anything like that, but I can see the merits and how that can work. But what are your views in terms of any specific product areas, or that aren't just right for now but right for the long term?
I mean, from a product perspective, clearly there's a greater focus on income.
Yeah.
Right. So providing an income stream that satisfies individual needs and lifestyle objectives, and everyone's different. And this is why it gets so hard. Finding the right type of product that can be tailored for individuals according to their own requirements and their own risk profiles and so forth is a real challenge.
Who's going to deliver the technology boost then to actually build that infrastructure? If we're saying managers are squeezed in terms of costs, where can the industry provide that for those solutions which sound, and I've heard them, they sound fantastic, because it's just the democratization of investment. But where's that going to come from, the AI build out to support that?
Well, I guess the obvious place would be superannuation funds.
Yeah.
They've got the size, they've got the membership, investing in technology to provide the access to solutions, and importantly, access to advice. I think the need for financial advice, particularly around retirement, is critical. And for reasons as we discussed earlier, people either can't afford them, don't appreciate the value that financial advisors provide. There aren't enough financial advisors to support, and there's red tape and regulations and legislation that makes it difficult for advisors to provide anything but a full comprehensive review, which then makes it expensive, hence back to where we started. That can be broken down, providing the regulatory environment's right, with technology.
Yeah.
Technology solutions exist to provide low-cost digital advice, augmented by humans, by people, for advisors, but certainly reducing the friction and the cost to end consumers, provides them with a low-cost solution to get, and this is probably the nirvana, low-cost advice that then guides them into solutions product solutions that should provide them can be tailored towards their own needs.
And if we look at the speed of progress over the last few years, it's comforting to think that the appetite for people to then accept that if the technology can get to the level that it's personalised, because around that pre-retirement, at retirement, it's very complex. I mean, everybody has different. Some people have very straightforward situations, but some people have more complex. And if the technology can match that, then the future looks quite rosy in terms of matching the industry delivery with the sort of lubrication to bring the market to the industry and vice versa. So thanks, Brett. That's been a fascinating conversation, and I appreciate you coming in today. If anybody would like to hear more about what's happening at CoreData, then please contact me on craig.phillips@coredata.com.au.